21st Century Entrepreneurship with Martin Piskarik.
Did you guys know that the commercial real estate sector has undergone a historic market correction? Pricing on a lot of properties, think about apartments, self-storage facilities, warehouses, industrial. Pricing's down anywhere from 20 to 30% over the last few years. Right now is a very opportune time to be getting into this space from an investment standpoint. My name is Mark Khuri. I'm the co-founder and CEO of SMK Capital Management. I've been a real estate investor for over 20 years, and our firm has been providing passive investment opportunities to our clients since 2010. For the last 15 years, we've created and managed over 65 different real estate partnerships with our clients over the years. And we take a diversified approach, investing in multiple assets, regions, and operating partners. We do that because it helps investors reduce risk and it helps them earn great returns over the investment cycle. We also co-invest in each of our investments alongside of our clients with really a focus on earning passive income and growth. Almost all of our investments provide our clients with cash flow and distribution starting in the first year. And they also have really attractive tax advantages where investors can earn passive losses through the depreciation from the real estate. Now, when we talk about diversification, we really are talking about spreading our capital across different properties, different regions, and different managers or operating partners. If you think about traditional real estate investing, many people think, okay, I'm going to buy a home or a duplex or a 4-unit, and you'll rent it out and have that asset as part of your portfolio. That's really considered to be more of a active investment. Your job as the owner is to manage the property manager if you have one, secure the debt, the financing, make all the decisions. You're actually quite involved in what goes on with that asset. We focus more on providing our clients with passive investments where we're teaming up with real estate experts, different companies in certain sectors that are, real pros in what they do. And so, for example, we will look at an apartment community. Maybe it's 300 units in a suburb of Dallas, Texas that we like. It's already 95% occupied, but the units are outdated and there has been some mismanagement by the seller. And so a lot of times what we'll do is we'll acquire this asset, and over the next few years, we'll renovate the units, we'll increase the revenue, the income that the property is producing. That will benefit all of us, our investors as well, with income, with growth, and then probably sell the asset in maybe 5 years for a profit. And so that's a bit more on the passive side. We are relying on others to execute the day-to-day operations. We're relying on our operating partners to secure the financing. And so passive investors aren't taking on as much risk, and they are getting quarterly updates, quarterly distributions on their investments. So it's really a great way for folks to, spread some of their portfolio and allocate capital to private real estate outside of, the public markets and stocks and bonds and mutual funds, and to allow themselves to diversify further. So now within this framework, if you think about looking at these passive investments, what we do at SMK every day, we're looking at 2 to 3 different investment opportunities or properties that are soon to be or currently able to accept our capital. And as a fund manager at SMK, we take this step very seriously. So we look at, again, roughly 2 to 3 opportunities a day, but we only invest in, 5 to 8 a year. And so about 98, 99% of the investment opportunities out there that we see in our space, in commercial real estate, we pass on. We say no to them through due diligence, vetting, underwriting, analysis. We really are trying to, what we say, cherry pick the best deals out there, right? There's plenty of opportunities. You can go on Google and find an endless amount of investment opportunities. But how do you really decipher between where the great deals are and where the risks are? And that's where our specialty comes into play. We were doing that every day, again, for the last 15 years, trying to really find those opportunities that we think have a very, I would say, attractive risk reward ratio, right? We're looking for the lowest amount of risk with the highest potential upside. And at the end of the day, when we're analyzing an investment, in order for it to proceed through our process and for us to share it with our investors as an active investment opportunity, we in essence need to walk away from our analysis and say to ourselves that we have very high conviction that we're going to be able to meet or beat the projected returns. That's the goal of all of our underwriting and analysis and the process that we bring to the table with vetting and analyzing investments for our folks. So a few points and tips I can share regarding analyzing commercial real estate investments. What should you look for to help reduce risk? Now we have, of course, a pretty robust process and due diligence checklist, but a few points I'll share with you today. Starting out, looking at the projected occupancy, right? How full is the property? Is it 70% occupied or is it 95% occupied, right? Obviously, there could be some upside potential if you're able to take that 70% to 95, but you also need to understand why it's not already at 95%. And the same for those deals that are 95% occupied. Where do we project that to go forward? How are we coming up with those assumptions, right? Those estimates on future occupancy, because occupancy affects revenue directly. And so the higher occupancy doesn't always mean higher revenue, because if you just manage to occupancy, your rents might be too low, and then you may not get the most optimal revenue. And so we like to look at both revenue and occupancy, try and make sure we understand where that projection is going and get comfortable with it. Another example of, looking at analysis is the acquisition price. What are you paying for the asset? All right. And this is really important today. We've seen price declines of, again, almost 20 to 30% over the last few years. So it's an optimal time to be buying and getting into these assets, but you still have to be careful that you're not overpaying and you want to make sure you're getting a great price. And so one of the ways to do that, of course, is to look at comparable sales. Now, this is important, not just looking at a few, but you want to map them out. How far away are they? What types of amenities do the other assets have compared to this one? Is there a washer and dryer in every unit? Is there a pool? What kind of concessions or giveaways has the previous seller been providing in order to get their property leased up? And then from there, really analyzing rental comparables, like what are the rents at the other properties in the market compared to ours, and why are they lower? Why are they higher? Really trying to better understand the demand for your asset compared to the others in the submarket, and of course the pricing. And be careful, one thing we see a lot of with a lot of operating partners deals, you can find folks that will cherry pick sales comps. Watch out for that. Map them out. Find out how close they are to the asset, right? We looked at a deal last week, for example. There was 5 comparable sales. 3 of them were 12 miles away. That's too far. That is not a comparable sale. You want to stay within 3 miles, and the closer the better. And then 2 of them were 20 years newer built. That doesn't help either, right? Vintage or age of the property is also a critical component when factoring in the price and the value. So try and find comps that are close by and that are of similar vintage or age to your property. Part of our underwriting criteria, guys, when we're looking for deals, what we're trying to achieve is call it a 3 to 7% cash flow to our investors in the first year. We like year one cash flow, not because 3, 4, 5, 6% is, going to change things for us financially, but because it reduces risk. It means that the asset is producing a good amount of cash flow right out the door, where if something should happen suddenly to the market, to the economy, etc., your investment is likely to be in a better protected position, since there isn't as much upside that you have to achieve to get to that cash flow. All right, so that's a starting point. But through the life of the investment, we're looking to achieve around a 15% average annual ROI to our investors. That includes the cash flow from the passive income plus the profits from the sale. And a lot of times what we're doing with our operating partners is we're negotiating more favorable terms for our investors. And what I mean by that is, when we have an operating partner that brings us an opportunity, a lot of times we have, active capital already with them. We're partners with them on many other deals. And when they get a live deal, they'll come to us. Hey, Mark, we've got this deal. Take a look. Is SMK or you or your family interested in investing with us? And if we like the opportunity, then we will either already have pre-negotiated terms, or we will create those with the operating partner where we will get more favorable economics. Think about return splits and income and management fees that they charge. We negotiate all of that to be more favorable for our group, making the net return to our investors really attractive. So that's a big part of, the deal making process. And then once we have a deal, we invest. We have an internal rule as far as communication to our investors that we respond to any inquiry or question within 48 hours. A lot of times it's same day, but that's essentially the guideline for us. And then on an ongoing cadence, we're providing our investors with quarterly reports. This is where we work hand in hand with our operating partners to kind of summarize we're on monthly or quarterly asset management calls. We're trying to really decipher how are things going compared to the initial plan. We're fully transparent with that. And so we provide quarterly reports and updates on performance, along with a distribution of the income to our investors as well. And so it's a big part of our process is transparency and communication with our investors. But it also works the other way, where our operating partners that we're working with, we require them to be fully transparent and communicate as well. And so we're routinely, analyzing financials on a monthly basis, profit and loss, cash flow statements. And if there's an operating partner that doesn't provide that, we'll know up front and we won't work with them. And so this is a big part of, how we think about our role, is to be able to essentially communicate effectively, efficiently, transparently, both with our operating partners and our investors regarding the investment and how it's going. Over the years, we've invested in over 15 different asset classes within real estate. And what we mean by that is different sectors. If you think about hotels, motels, Airbnb, vacant land, oil wells, we've done all of that. We've tried senior housing, student housing, you name it. So I'm going to share with you some of the real estate sectors that we are not pursuing today, that we don't invest in. And I'll also share with you those that we are. But to start with those that we don't invest in. We don't typically invest in development deals or ground up construction, where you have to go build the property and then lease it up before you get any return on investment. Now, there's ways to make great money in that space, but there's also higher risk. And so we tend to stay away from, investments that don't provide income day one. And obviously, a project that isn't yet developed won't do that. Many times these deals take 3 to 4 years before you see any return on investment as an investor. So we tend to stay away from them due to the higher risk and not necessarily getting much higher return on investment. Also, we don't do a lot of student housing or senior housing deals. Again, you can make money in those spaces, but what we find is you have higher risk based on, for senior housing, more operating expenses. You've got to pay a lot of people, staff. If you think about assisted living, for example, and the cost of the payroll of those folks at those properties, it's quite high. A lot of times you'll see operating expenses that are 60% plus of the revenue that's coming in. And versus the deals that we often source, and I'll get to those in a minute, the operating expense ratios are usually 30 to 45%. So there's a lot more margin. We also don't find, again, that the return is much higher, or projected return is much higher in these asset classes than those that we do invest in. So, why take on extra risk if you're not going to get a substantially higher return? We also don't invest, again, in Airbnb and hotels or motels. Tend to find, more of a transient user base or tenant base. Revenues are a lot more clunky, up, down, seasonality, a storm, etc. can all affect revenue. So as far as what we do invest in, we've really focused over the last 15 years and narrowed down our strategy to what we call our 4 core investment asset classes. And in no order of priority, here they are. We love to invest in mobile home parks. They are the most affordable housing solution in the country. You tend to find very high demand and virtually no new supply. It's almost impossible to build a new mobile home park in a desirable location that is actually affordable, really due to zoning restrictions where it's just not allowed in that local municipality. That land is zoned for something that's likely to bring in higher tax revenue for the city. And so in short, you have a very affordable housing option, which continues to grow in demand. You have very limited supply, which increases likely the demand for the property over time. So supply demand economics 101, mobile home parks. The next asset class we like to invest in is self-storage. It has historically done well during economic downturns and recessions. I would say it's lowly correlated to the overall economy, similarly to mobile home parks in that nature, where you often will see stable or consistent demand even during a downturn. One of the problems with self-storage is it is relatively low cost and easy to build a new one, and the new stuff competes with the older stuff. And so what that means is you're a lot more sensitive to new supply on self-storage. So we've got to be careful with that, but historically a great asset class to be in. Another asset class, the third one I'll mention, is multifamily or apartments. Relatively self-explanatory, but within the apartment space, we're very particular about which apartments we invest in, what vintage, what location, what type of strategy, etc. And so that's another asset class that historically does well over the long term and continues to perform usually well in different downturns. The last one for us, like I say, the 4 main, is industrial. We do invest in warehouses, distribution centers, a lot of manufacturing facilities. We've seen really attractive features in this space, especially lately. They're very inflationary resistant because the tenants, if it's a triple net structured lease, the tenant has to pay all the expenses. Think about property insurance and taxes and utilities and maintenance. All of that on a triple net lease structure is on the tenant's responsibility. And so that reduces or eliminates expenses for us, the owners in these assets, which is very helpful in an inflationary time when expense costs are going up. And so we love that space as well. And those are essentially the four main areas that we love to invest in and continue to focus on today. Now, one of the things that we do that makes us a bit unique is we will take these specific asset classes that we love to invest in, and we will blend them all together into a diversified fund. So there is no perfect investment. Every investment has risk. But by putting some of the best investments together in a fund and spreading investors' capital across each one, you're then inherently reducing investors' risk even further, while also getting the benefit of the cash flow and the upside and the growth of the investment. So if you're a passive accredited investor and you'd like to learn more about what we do and how we do it, I would encourage you all to go to our website, smkcap.com. Again, our company name is SMK Capital Management. Our website is smkcap.com. You can sign up to join our investor network. We provide a lot of educational content and, of course, investment opportunities as well. And I would also suggest everyone to schedule a call with me so we can discuss your goals and see if we might be a good fit. Again, all of that is available right through our website.
21st Century Entrepreneurship with Martin Piskarik.
Imagine a space where triumphs, trials, and tales of entrepreneurship come alive. Welcome to the 21st Century Entrepreneurship Podcast, a gold awarded journey hosted by Martin Piskarik, connecting with listeners in 95 countries and ranking in the top 0.5% of all podcasts. Join our exclusive community, elevate your perspective, and embark on the path to success.